Ever wondered why some Forex traders consistently make profits while others struggle to break even? Welcome to the intriguing world of Forex, the foreign exchange market, where currencies are bought and sold. It's a global marketplace that never sleeps, a world where fortunes can be made or lost on the strength of a nation's currency. But how do successful traders navigate this volatile landscape? The answer lies in their trading strategies. These strategies are the compass that guides traders through the unpredictable waves of the Forex sea, helping them make informed decisions and mitigate risk. Today, we're going to delve into these strategies, demystifying the concepts behind them and showing you how they can be applied. We'll cover the basics of the Forex market, delve into technical and fundamental analysis, and explore common Forex trading strategies. So buckle up and get ready for an enlightening journey. Join us on this journey as we unravel the secrets behind successful Forex trading strategies. To master Forex trading, you first need to understand the basics of the Forex market. The Forex market, short for foreign exchange, is where currencies are traded. It's an international market, open 24 hours a day, 5 days a week, making it the largest and most liquid market in the world. Now let's talk about currency pairs. These are the foundation of Forex trading. A currency pair is composed of a base currency, which is the first currency listed, and a quote currency, the second one. The most traded ones are the major pairs, which include combinations of the US dollar, euro, British pound, Japanese yen, Canadian dollar, Swiss franc, and Australian dollar. Next up, we have currency values. In Forex, currencies are quoted in pairs, and the exchange rate is the value of the base currency in relation to the quote currency. For example, if the EUR-USD pair is quoted at 1.18, it means you need 1.18 US dollars to buy 1 euro. Moving on to the concepts of buying and selling. In Forex, you can either buy or sell a currency pair. When you buy, also known as going long, you're betting that the base currency will rise in value compared to the quote currency. On the other hand, when you sell or go short, you're expecting the base currency to fall in value. Remember, Forex trading isn't just about speculating on the rise of a currency, but also on its fall. It's this dual possibility that makes Forex trading quite exciting and potentially profitable. But be aware, while the potential for profit is high, so is the potential for loss. It's crucial to develop a solid understanding of the market dynamics and establish a well-thought-out trading strategy before diving in. With these basics in mind, you're now ready to delve deeper into the world of Forex trading. Ever heard of the term technical analysis and wondered what it means? Well, let's unravel that mystery together. In the realm of Forex trading, technical analysis is a method traders use to evaluate investments and identify trading opportunities. It's all about analyzing statistical trends gathered from trading activity, such as price movement and volume. This analysis involves the use of various tools and charts to visualize patterns and trends. The goal is to predict future price movements based on historical data. It's a bit like trying to predict the weather based on past climate patterns. Not always perfect, but often quite useful. One of the most common tools in technical analysis is the moving average. Imagine you're looking at a chart of currency prices that looks like a wild roller coaster ride. Now smooth out those peaks and valleys with a line that shows the average price over a specific period. That's your moving average. It helps traders identify potential buy and sell signals, smoothing out the noise of fluctuating prices. Then we have the Relative Strength Index, or RSI. Despite its intimidating name, its job is simple. It measures the speed and change of price movements. It's a bit like a car's speedometer, but for price changes. If the RSI is high, say above 70, that might indicate the currency is overbought. If it's low, under 30, the currency might be oversold. Traders use this to gauge whether a reversal may be in the cards. Another key player in technical analysis is the Moving Average Convergence Divergence, or MACD. This tool is all about momentum and trend following. The MACD comprises two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, it might be a bullish signal. When it crosses below, it could be a bearish signal. Now let's talk about how traders use these tools. Suppose a trader is watching the moving averages of a currency pair. If the short-term average crosses above the long-term average, this could signal that the pair's price is gaining upward momentum. The trader might decide to buy. Conversely, if the short-term average crosses below the long-term average, it could be a sign to sell. Similarly, a trader might use the RSI to identify potential price reversals. If the RSI is extremely high or low, the trader might anticipate a price correction and take a position accordingly. In the case of the MACD, if the MACD line crosses above the signal line, a trader might consider this a buy signal. If the MACD line crosses below the signal line, they might interpret this as a sell signal. Remember, these tools and indicators are not crystal balls. They can't predict the future with 100% accuracy, but they can provide valuable insights into market trends and potential trading opportunities. Technical analysis can be a powerful tool, but it's not the only one at a trader's disposal. After all, Forex trading is a complex game, and it requires a diverse toolkit to play it well. While technical analysis is important, it's equally crucial to understand the role of fundamental analysis in Forex trading. So, what exactly is fundamental analysis? It's a method of evaluating a currency's intrinsic value by examining related economic and financial factors. This includes everything from macroeconomic indicators like inflation rates, interest rates, and gross domestic product, GDP, to geopolitical events and economic news releases. These elements can have significant impacts on a currency's value. For example, if a country's central bank announces a hike in interest rates, it might lead to an increase in the value of that country's currency. Why? Because higher interest rates often attract foreign investors looking for a better return on their investments. On the flip side, political instability or poor economic performance can weaken a currency. Then we have economic news releases, which are scheduled announcements about key economic indicators. Traders often pay close attention to these as they can cause significant volatility in the currency markets. Some of the most impactful include employment data, central bank minutes, and inflation reports. But how do traders use fundamental analysis? Well, they attempt to predict how these economic indicators and events will move the market. Then, they use this information to make informed trading decisions. For instance, if traders anticipate that a country's upcoming GDP report will exceed expectations, they might buy that country's currency in anticipation of its value increasing. Conversely, if they expect a poor employment report, they might sell the currency, expecting its value to decrease. Fundamental analysis is not about pinpoint accuracy. Rather, it's about understanding economic trends and market sentiment. It allows traders to make educated guesses about future currency movements based on current economic conditions. Remember, no single method can predict market movements with absolute certainty. Both technical and fundamental analysis have their strengths and weaknesses. However, when used together, they can provide a more comprehensive view of the market. Combining technical and fundamental analysis can give traders a comprehensive view of the market. Now that we've covered the basics, let's dive into some common Forex trading strategies. First, we have the trend-following strategy, a classic approach used by many traders. This strategy involves identifying a trend in the market and making trades that align with this direction. For instance, if the value of a currency pair is consistently rising, a trader employing a trend-following strategy would buy or go long on that pair. Conversely, if the trend is downward, the trader would sell or go short. This strategy is based on the assumption that the trend is your friend, and it's better to move with the current than against it. Next up is the breakout strategy. This is based on the principle that when the market moves beyond a certain level, it's likely to continue in that direction. These levels could be a previous high or low, or a key level identified through technical analysis. Once a breakout is identified, the trader enters the market with the expectation that the trend will continue. Finally, let's discuss the range-bound strategy. This strategy is best suited for markets that are moving sideways, with no clear upward or downward trend. Traders identify the upper and lower boundaries of the range and aim to buy at the lower end and sell at the higher end. This strategy works best in stable markets and requires careful monitoring of market movements. However, it's crucial to remember that no strategy is perfect. Each comes with its own set of risks and challenges. That's why risk management is a key component of any successful Forex trading strategy. This involves setting appropriate stop-loss and take-profit levels to protect your capital, and never risking more than a small percentage of your trading account on a single trade. Remember, no strategy is foolproof, but with careful planning and risk management, you can increase your chances of success. We've covered a lot today, so let's quickly recap. We started by understanding the Forex market, where currencies are traded in pairs and their values constantly fluctuate. We learned that buying means going long on a currency, expecting its value to rise, and selling means going short, anticipating a decrease in value. We then delved into the vital role of technical analysis, using indicators like moving averages, relative strength index, and MACD to predict future price movements. We also explored fundamental analysis, understanding how key economic indicators and events can influence currency values. Next, we discussed common Forex trading strategies, such as trend following, breakout, and range-bound strategies. We emphasized the importance of risk management in successfully implementing these strategies. Forex trading is a continuous learning journey. Keep exploring, keep learning, and most importantly, stay disciplined in your approach.